Okay, let's unpack this. In today's dynamic business world, understanding financial statements isn't just for accountants. It's crucial for anyone who wants to grasp a company's true financial health. But what if those statements don't always tell the full story, especially when it comes to something as common as leases? Welcome to the Deep Dive, the show that cuts through the complexity and gets straight to the nuggets of knowledge you need to be truly well informed. Today, we're plunging into a monumental shift in the world of Indian accounting standards, in AS 116 on leases. This standard has profoundly changed how companies report their financial position, bringing clarity and transparency to what was once a somewhat opaque area. For you, our listener, whether you're a seasoned professional prepping for a critical exam or just intensely curious about what those balance sheet numbers really mean, mastering this standard is invaluable.
Absolutely. And ADAS 116 isn't just an update. It represents a fundamental reimagining from previous accounting standards like IND 17. The core idea is to move most leases onto a company's balance sheet, providing much more faithful representation of their assets and liabilities. Our mission today is to give you a comprehensive, in-depth walkthrough, ensuring every concept, every nuance, and every practical application is laid bare. Think of this as your essential roadmap to not just understanding but truly mastering lease accounting under IND AS 116.
Exactly. So, whether you're navigating complex financial reports, preparing for that crucial professional exam, or simply want to understand the economic impact of leasing decisions, get ready. We're going to break down every facet of in AS 116, strictly following the standard's logical flow. Here's where it gets really interesting because we're not just reading rules, we're exploring the why and the impact behind them. Every accounting standard, no matter how complex, starts with a clear purpose. It's the North Star that guides all the subsequent rules. So let's start at the very beginning. What's the driving force, the core objective behind the entire NDAS 116 framework?
The primary objective, clearly laid out in paragraph 1 of the standard, is to ensure that both lessees and lessors provide relevant information that faithfully represents their lease transactions. The driving force is truly about enhancing transparency and comparability. You know, this information is intended to give users of financial statements, think investors, creditors, and other stakeholders, a solid, consistent basis to assess the effect that leases have on an entity's financial position, its financial performance, and crucially, its cash flows. It's about making sure that the financial statements truly reflect the economic reality of a company's obligations and assets, allowing for better decision-making. It also emphasizes that an entity must apply this standard consistently to contracts with similar characteristics and in similar circumstances, promoting apples-to-apples comparisons across different companies and periods.
That really clarifies the objective. So it's all about equipping investors and other stakeholders with the clearest possible picture, making hidden liabilities a thing of the past, and ensuring everyone's playing by the same rules. It's easy to see how this fundamental why then underpins all the subsequent intricate how of the standard.
Precisely. Understanding that foundational why helps you connect the dots as we delve into the how, especially when you're facing those application-based questions that test your grasp of the underlying principles.
Okay, so we know the why. Now let's talk scope. What types of leases actually fall under IND AS 116?
And AS 116 is designed to be broad, applying to all leases, including leases of right of use or ROU assets, when an entity is acting as an intermediate lessor in a sublease. But it's equally important to know its boundaries. There are 5 specific exceptions mentioned in paragraph 3 where the standard does not apply. These are critical to remember for scope-related questions, as misidentifying them can lead to incorrect accounting.
Right, the exceptions. Always important. What are they?
First, leases to explore for or use minerals, oil, natural gas, and similar non-regenerative resources. These fall under IND AS 106, which specifically deals with exploration and evaluation of mineral resources. They're just very specialized. Second, leases of biological assets held by a lessee are excluded. These are covered by IND AS 41, agriculture, think livestock, plants. Different accounting needed there.
Okay, minerals and biology out. What else?
Third, service concession arrangements are out of scope for IND AS 116. They're dealt with under Appendix D of IND AS 115, revenue from contracts with customers. These often involve public infrastructure management, so it's more about the service. Fourth, licenses of intellectual property granted by a lessor are also within the scope of IND AS 115, not IND AS 116. Fixed software license is more like a service right.
IP licenses from the lesser side.
Okay.
And the last one.
And finally, rights held by a lessee under licensing agreements for specific items like motion picture films, video recordings, plays, manuscripts, patents, and copyrights. These kinds of rights are covered by IND AS 38, intangible assets, recognizing them as intellectual property rather than a traditional lease of a tangible item.
Those are pretty specific exclusions, and it's a good list to internalize. But I noticed something in paragraph 4 about intangible assets that seems to add a layer of nuance. What's the deal there? It seems like a subtle point that could easily be overlooked, yet might be crucial for understanding the full scope.
Good catch. This is a classic detail that often surfaces in application questions. While rights under licensing agreements for specific intangible assets like films or patents are explicitly excluded in paragraph 3E because they fall under IND AS 38, a lessee may elect, but is not required to, apply IND AS 116 to leases of other intangible assets. It's an optional choice for the lessee.
Optional. So not a hard rule for all intangibles.
Exactly. So the key takeaway is that it's not a hard rule for all intangible assets. This gives lessees some flexibility, perhaps for, say, a lease of a specific piece of software that isn't a license agreement in the IND AS 38 sense, but functions more like a traditional asset lease. For you, our listener, that distinction between specific licensing agreements being out and other intangible assets being optional is quite subtle, yet vital for a complete understanding of the standard's reach.
So we've defined what is and isn't generally in scope. But even for leases squarely within IND AS 116's boundaries, I hear there are situations where a lessee can choose not to apply the full recognition requirements. Like they don't have to put an RU asset and a lease liability on their balance sheet. Can you walk us through those? These sound like practical expedients.
Yes, absolutely. These are incredibly valuable practical expedients, as per paragraph 5, that allow a lessee to simplify accounting for certain types of leases, avoiding the full recognition and measurement process, but they come with specific conditions.
Okay, what are the conditions?
First, there are short-term leases. These are defined as leases that, at the commencement date, have a lease term of 12 months or less. A critical additional condition here is that they must not contain a purchase option. If there's any option for the lessee to purchase the underlying asset, even a lease of less than 12 months doesn't qualify.
No purchase option, 12 months or less.
Got it. And this election is made by class of underlying asset. So if you choose it for, say, all your short-term office equipment leases, like printers, you must apply it to all such leases within that entire class. You can't pick and choose. Consistency is key.
Class of underlying asset for short term. Okay, what's the other exemption?
Second, there are leases for which the underlying asset is of low value. Now, interestingly, the standard doesn't give a specific monetary threshold for low value, leaving some room for judgment. But it does provide conditions and examples. An asset is considered low value only if both the lessee can benefit from its use, either on its own or with other readily available resources, and the asset is not highly dependent on or integrated with other assets.
Like a tablet or office furniture?
Exactly. Think tablets, personal computers, small office furniture, telephones, those kinds of things. However, the standard is quite explicit about what generally doesn't qualify. For instance, leases of cars would not qualify as low-value assets, nor would a head lease, where an intermediate lessor intends to sublease the asset.
Okay, no cars, no head leases for low value. How is the selection made?
This particular election, unlike short-term leases, can be made on a lease-by-lease basis. So you could, in theory, choose it for some identical laptops, but not others, though practically companies often apply it consistently.
So for anyone preparing for an exam, understanding the difference between class of underlying asset for short term and lease by lease for low value is super important. And those exclusions, like cars, what actually happens in the financial statements if a lessee makes these elections? How do they account for them?
Right. If either exemption is chosen, the lessee doesn't apply the full ROU asset and lease liability model. Instead, they recognize the lease payments associated with those leases as an expense. This expense is typically recognized on a straight-line basis over the lease term in their profit and loss statement.
So just like the old rent expense under IND AS 17 for operating leases.
Pretty much, yes.
Yeah.
It simplifies things for minor leases. You expense it as you go, generally straight line, unless another systematic basis better reflects the pattern of benefit.
Okay, that makes sense. Now, let's get to the very heart of IND AS 116. How do you actually know if a contract is a lease or contains a lease? Paragraph 9 tells us it's not always obvious, right? This seems like the crucial gateway question. Get this wrong and everything else is off.
That's absolutely right, and it's the fundamental starting point. At the inception of a contract, an entity must meticulously assess this. A contract is, or contains, a lease if it conveys the right to control the use of an identified asset for a period of time in exchange for consideration. This definition, while similar in principle to older standards, provides much more detailed guidance, especially around the crucial concept of control.
Mm.
It emphasizes substance over form.
So control is definitely the key word here. It's not just about having access, but truly controlling its use and benefits. Let's break down those elements. What about the identified asset part first? An arrangement only contains a lease if there's an identified asset. How do we determine that? Does it have to be explicitly named?
It can be explicitly specified in a contract, like a specific building address, a serial number, a vehicle registration, very clear. Or it can be implicitly specified by being made available for use by the customer. For example, if a customer contracts for, say, rolling stock specifically designed for them, and the supplier only has one such item capable of fulfilling that unique order, well, even if the contract doesn't name it, it's implicitly identified.
Okay, explicit or implicit. But I hear there's a catch involving substitution rights.
Yes, a critical factor, often tested, is substantive substitution rights. Even if an asset is specified, the customer does not have the right to use an identified asset if the supplier has the substantive right to substitute it throughout the period of use. And this right is substantive only if both demanding conditions exist.
Both. Okay, what are they?
First, the supplier has the practical ability to substitute alternative assets throughout the period of use. This means alternatives are readily available, and the customer can't prevent substitution. If it's installed at the customer's site, maybe substitution isn't practically possible. Second, the supplier would benefit economically from exercising that right, maybe to fulfill another order, or due to a technical upgrade, or to save costs. It has to be a real economic benefit, not just a clause in the contract.
So the supplier can't just have the right to swap assets on paper. They must realistically be able to and want to do it for genuine economic reasons. That's crucial. What if the customer can't readily tell if the supplier's right is substantive? Maybe they lack transparency into the supplier's operations.
That's a very practical point. And the standard offers a pragmatic approach. If the customer cannot readily determine whether the supplier has a substantive substitution right, the customer should presume the substitution right is not substantive. This avoids undue effort from the customer. It's practical out. Also, rights to substitute only for breakdowns, technical upgrades, or after a specific date are not considered substantive because the supplier can't just swap it out whenever they want throughout the whole period.
Okay, presume not substantive if unclear. Makes sense. Any other points on identified assets?
Yes, one last thing. It must be physically distinct. This could be a whole asset, a distinct portion like specific floors of a building, or even a capacity of an asset. But if it's a capacity like pipeline capacity, or a portion that isn't physically distinct, like fiber optic bandwidth, it's only identified if that capacity represents substantially all of the asset's capacity, giving the customer substantially all the economic benefits from its use.
Substantially all the capacity and benefits. Okay,
Yeah.
so we have an identified asset, no substantive substitution rights. What's next? The control part.
Exactly. The next step, and arguably the most important, is determining if the contract conveys the right to control that identified asset's use. Control requires the customer to have both of the following rights throughout the period of use.
Both again. Okay, what are these two rights for control?
First, the right to obtain substantially all of the economic benefits from use of the identified asset. This means the customer gets the asset's primary outputs, goods, services, any byproducts like renewable energy credits, and other benefits like subleasing rights. Even if the contract limits use, like a mileage cap, you only consider benefits within that scope. And crucially, if the customer pays a portion of cash flows from using the asset back to the supplier, like a percentage of sales from retail space, it doesn't prevent control. Those cash flows are still benefits the customer obtains first.
Right, they get the benefit, then pay some back as consideration. Okay, that's the benefits part. What's the second right for control?
Second, the right to direct how and for what purpose the identified asset is used. This is about making the most relevant decisions affecting the economic benefits. Decisions like changing what output is produced, where and when it's produced, whether it's produced at all. It's about steering the asset's productive capacity. Just operating or maintaining the asset usually isn't enough unless those rights let you change the fundamental how and for what purpose.
So it's not just passively using it, but actively deciding how it's used to maximize your benefits. That makes sense. But what if those decisions about how and for what purpose are already set in stone by the contract or the asset's design? Does that mean no control?
Not necessarily. The standard addresses this. If the decisions are predetermined, the customer still has the right to direct use if they either 1. Have the right to operate the asset or direct others to operate it throughout the period, without the supplier changing instructions. Or 2, design the asset or specify critical aspects in a way that predetermines its use, like commissioning a factory to exact specs. If the customer didn't design it and only specifies output, it's generally seen as buying good services, not a lease.
Okay, operation or design can still mean control, even if use is predetermined. What about protective rights the supplier might have?
Good point. Protective rights held by the supplier like mileage caps, requiring notice of use changes. Safety rules do not, in isolation, prevent the customer from having the right to direct use. These typically define the scope of use, the boundaries, rather than dictating the fundamental how and for what purpose decisions within those boundaries. They protect the supplier's asset interest.
Right, they set the playground rules, but the customer decides how to play within them. Okay, that clarifies control significantly. Now, many contracts aren't simple. They bundle assets, services. It can get messy. How does NAS 116 handle separating these components?
This is where separating components comes in, paragraph 12, and it requires careful application. For a contract containing a lease, you must account for each lease component separately from other lease components and non-lease components unless you use a practical expedient.
Okay, separate lease components and non-lease components. How do you identify a separate lease component?
A right to use an asset is a separate lease component if both conditions are met. 1. The lessee can benefit from the asset either on its own or with other readily available resources, things sold leased separately or already obtained. 2. The asset is neither highly dependent on nor highly interrelated with other assets in the contract, so leasing an office building and furniture, likely separate components. But a custom-built HVAC system integrated into the building, probably part of the building component.
Interdependence is key. And what about non-lease components?
These are goods or services transferred to the lessee separate from the asset use itself. Think maintenance services, utilities, providing a driver for a leased truck, things you could arguably buy separately. But payments for things like property taxes or insurance the lessor owes anyway, or admin tasks, those aren't separate components. They're just part of the overall consideration for the lease and get allocated.
So a distinct service provided to the lessee is a non-lease component. Got it. Is there a way to simplify this?
Yes, there's a significant practical expedient for lessees. A lessee may elect, by class of underlying asset, to treat each separate lease component and any associated non-lease components as a single lease component. So that truck lease plus maintenance. You could elect to treat it all as one lease component. Big simplification. But crucially, this expedient is not available for lessees. They must always separate.
Okay, lessee simplification available, lessor must always separate. If the lessee doesn't use the expedient, how is the money allocated?
If the practical expedient is not used, the lessee must allocate the total contract consideration to each lease component and non-lease component based on their relative standalone prices. If standalone prices aren't readily observable, you have to estimate them, which requires judgment.
So using my earlier example, office building with integrated HVAC is one lease component. Office furniture is another separate lease component. Common area maintenance is a non-lease component. Unless the lessee uses the expedient and combines, say, the furniture lease with the maintenance service.
No, the expedient combines a lease component and its associated non-lease components. So they could combine the building HVAC component with the maintenance, or the furniture component with any maintenance specific to it. But they couldn't combine the building lease with the furniture lease using this expedient. It's about bundling lease plus related service, not lease plus lease.
Ah, subtle but important distinction. Okay. What about multiple contracts signed together?
Right, contract combinations. Sometimes entities sign multiple contracts around the same time with the same counterparty. In AS 116, Appendix B requires combining them if they're negotiated as a package, if consideration in one depends on the other, or if the assets form a single lease component. It prevents artificial splitting.
Makes sense. Now, dates matter a lot. What's the difference between the inception date and the commencement date of a lease, and why do we care?
This is a really important distinction. The inception date is the earlier of the lease agreement date or the commitment date to principal terms. This is when you assess if it's a lease and classify it for lessors. It's the assessment date. The commencement date, however, is when the lessor makes the asset available for use by the lessee. This is the date the lessee starts recognizing the ROU asset and lease liability.
So inception is about identification and classification. Commencement is about recognition on the balance sheet. Critical timing difference.
Exactly. You might sign in January inception, but the asset isn't ready until April commencement. Accounting starts in April.
Okay. Another key concept. the lease term. It drives depreciation and liability measurement. How is it determined, especially with renewal or termination options?
The lease term, paragraph 18, is the non-cancelable period of a lease, plus two things. One, periods covered by an option to extend the lease if the lessee is reasonably certain to exercise that option. Two, periods covered by an option to terminate the lease if the lessee is reasonably certain not to exercise that option.
Reasonably certain. That sounds like judgment is involved.
Huge judgment. It's about assessing all relevant facts and circumstances that create an economic incentive for the lessee. Think significant leasehold improvements you'd lose, strategic location, high cost to move, market conditions. It's not just intention, it's objective factors.
What about leases that seem cancelable, like month to month? How does enforceability play in?
Good question. Often tricky. If both the lessee and the lessor can terminate without more than an insignificant penalty, the lease term is generally just the non-cancelable period. Neither side is really locked in beyond that. But if only the lessor can terminate, that period is included in the non-cancelable term for the lessee. If only the lessee can terminate, it's a termination option, and you assess if they're reasonably certain not to exercise it. So the term could be longer if there are big disincentives for them to leave.
And this isn't a one-time assessment.
Correct. Lessees need to reassess the lease term after commencement if there's a significant event or change in circumstances within their control that affects that reasonable certainty assessment.
Okay, lease term assessment is ongoing. Now, let's talk lease payments, the core of the liability calculation. What exactly makes up lease payments?
Lease payments, Appendix A, paragraph 27, are crucial. They include 1. Fixed payments, including in-substance fixed payments. These might look variable but are unavoidable, like a minimum monthly payment. These are reduced by any lease incentives receivable. 2. Variable lease payments that depend on an index or a rate, measured initially using the index rate at commencement date, like CPI or a benchmark interest rate. 3. Amounts expected payable under residual value guarantees by the lessee. 4. Exercise price of a purchase option, if reasonably certain to be exercised. 5. Penalties for terminating, if the lease term reflects exercising a termination option.
Okay, that list is specific. What about other variable payments, like those based on sales or usage?
This is a critical distinction, especially for exams. Other variable lease payments, like those based on sales or usage, are excluded from the lease liability. They're expensed in profit or loss as incurred.
Excluded entirely from the liability. Wow. So a retailer paying rent based on sales sees that hit their P&L directly each period.
Exactly. It doesn't get smoothed into the liability. It reflects the operational variability directly.
Why the distinction? Why are index rate variables included but usage sales variables excluded?
The thinking is mainly about predictability and controllability. Payments tied to an index or rate are, well, generally more predictable. They're based on external factors. You can reasonably forecast them. Payments based on sales or usage, however, are highly dependent on the lessee's own performance or decisions. The standard views these more like operating expenses incurred as the benefit is consumed rather than a fixed commitment for the right to use the asset itself.
So for an investor comparing two retailers, one with CPI-linked rent and one with sales-based rent, the sales-based one will show more P&L volatility in that expense line.
Precisely. Their rent expense tracks their performance directly. Lower fixed cost in a downturn, maybe, but potentially lower margins in an upturn compared to the CPI-linked competitor. It shows a different operating leverage and risk profile.
Very interesting implication. Okay, another term. Initial direct costs, IDCs. What are they and how are they treated?
Initial direct costs are the incremental costs of obtaining a lease that wouldn't have been incurred otherwise. Think commissions, legal fees for drafting, stamp duty, cost directly tied to getting that lease signed. Advertising, for example, is excluded because you'd likely incur that anyway, lease or no lease.
Okay, incremental costs. How do lessees and lessors handle them? Is it the same?
Not quite. For lessees, IDCs are included in the initial measurement of the right-of-use asset. They get capitalized and depreciated. For lessors, but not manufacturer or dealer lessors, IDCs are included in the initial measurement of the net investment in the lease for a finance lease. Effectively reduces income over time. But for manufacturer or dealer lessors, they expense these costs immediately at commencement because they relate to earning their selling profit on the sale part of the finance lease. Big difference there.
Expense immediately for manufacturer dealer lessors. Good point. Now, discounting is key for present value. Which discount rate does a lessee use?
A lessee must use the interest rate implicit in the lease, if it can be readily determined. That's the rate the lessor uses, essentially making the PV of payments plus unguaranteed residual value equal the asset's fair value plus lessor's IDCs. But often, the lessee can't readily determine this rate. They might not know the lessor's costs or residual value estimate.
So if the implicit rate isn't known,
Then the lessee must use their incremental borrowing rate, IBR. The IBR is the rate the lessee would pay to borrow funds over a similar term, with similar security, to obtain an asset of similar value to the ROU asset in a similar economic environment.
that sounds complex to figure out.
It requires significant judgment. It's specific to the lessee, the currency, the security, and crucially, the term of the ROU asset, the lease term, not the underlying asset's whole life. Getting this rate right significantly impacts the liability and asset values.
Okay, IBR is the fallback. Lastly, for this section, quick definitions: economic life and fair value.
Generally consistent with other standards. Economic life or useful life is the period the asset's expected to be usable or the output expected. Fair value for lessors is the arm's length exchange price, basically carrying over the IND AS 17 idea. Notably, IND AS 113 fair value measurement is not applicable for this fair value determination under IND AS 116 for lessors, a specific carve-out there.
So standard terms, but watch the specific application context, especially that IND AS 113 point for lessors. Okay, that covers the foundational concepts. Let's move into lessee accounting. This is where the big changes really hit, right?
Absolutely. This is the core of the single lessee accounting model.
So what actually hits the balance sheet at commencement, assuming no exemptions?
At the commencement date, a lessee recognizes both a right-of-use ROU asset and a lease liability. This is a fundamental right-of-use approach. Almost all leases now come onto the balance sheet.
Okay, ROU asset and lease liability. How are they measured initially? Let's start with the liability.
The lease liability is the present value of the lease payments not paid at that date. These payments are discounted using the interest rate implicit in the lease, or if that's not readily determinable, the lessee's incremental borrowing rate. And remember, lease payments includes those specific components we discussed: fixed, index rate variable, residual value guarantees, purchase options is certain, termination penalties if applicable.
Right, PV of those specific future payments, and the ROU asset. How is its initial cost calculated?
The ROU asset is initially measured at cost. This cost is more comprehensive and includes 5 elements. 1, the amount of the initial lease liability itself, that's the base. 2, any lease payments made at or before commencement, less any lease incentives received. Think upfront payments adjusted for incentives. 3, any initial direct costs incurred by the lessee, like those legal fees or commissions. 4, an estimated cost to dismantle, remove, or restore the asset at the end, measured per IND AS 37 on provisions, if there's an obligation. 5, costs incurred using the ROU asset to produce inventories during period. Those get treated under IND AS 2, inventories.
Wow, so it's the liability plus upfront payments, net of incentives, plus IDCs, plus estimated restoration costs. Quite a basket.
Yeah.
Are more than just expensing rent.
Exactly. It captures the full economic commitment related to obtaining and using that right-of-use asset.
Okay, that's initial recognition. What about afterwards? How are the ROU asset and liability measured over time?
For the RU asset, the cost model is generally applied. So it's cost less accumulated depreciation and any accumulated impairment losses per IND AS 36. It also gets adjusted for any remeasurements of the lease liability. Lessees can elect the revaluation model from IND AS 16 if the ROU asset relates to a class of PPE they already revalue. But a key point for India: if an ROU asset is investment property under IND AS 40, the revaluation model cannot be applied. And AS 40 only allows the cost models for investment property here.
Cost model, usually revaluation possible for PPE class, but not for investment property in India.
Got it. How is depreciation handled? Depreciation depends on ownership transfer or purchase certainty. If the lease transfers ownership or the lessee is reasonably certain to exercise a purchase option, you depreciate the ROU asset over the underlying asset's useful life. Otherwise, you depreciate it over the shorter of the ROU asset's useful life, essentially the lease term, or the end of the lease term.
Okay, makes sense to depreciate over the period you control it. What about the lease liability subsequently?
The lease liability is treated like other financial liabilities on an amortized cost basis. Each period, you increase the carrying amount for interest expense, calculated using a constant effective interest rate, and decrease it for lease payments made. It also gets remeasured for certain changes.
So interest expense accrues, payments reduce it, classic amortization. What hits the P&L then?
2 main things hit P&L. depreciation expense on the ROU asset, and interest expense on the lease liability. And these must be presented separately. You can't just lump them into one lease expense. Any variable lease payments not in the liability, like usage-based ones, are expense as incurred, usually in operating costs. And ROU assets are subject to impairment testing under IND AS 36.
Separate depreciation and interest on the P&L, that's a big change in presentation. What if the lease is in foreign currency? You mentioned complexity.
Yes, IND AS 21 applies. The lease liability is a monetary item, so it is remeasured using the closing exchange rate at each reporting date. Any FX gain or loss hits P&L. The RU asset, however, is a non-monetary item at cost, so it's not remeasured for FX changes. This mismatched monetary liability non-monetary asset can create P&L volatility from FX differences.
Right. The liability value fluctuates with the exchange rate, but the asset cost doesn't. Potential P&L swings there. You mentioned the liability gets remeasured sometimes, even without a formal contract change. When does that happen?
A lessee must remeasure the lease liability if certain estimates or conditions change. These triggers include 1. A reassessment of the lease term, for example, change in certainty about an extension option. 2. A reassessment of certainty about exercising a purchase option. 3. Changes in amounts expected under residual value guarantees. 4. Changes in future payments due to a change in an index or rate, like CPI. 5. A change in substance fixed payments.
So if estimates about the future cash flows change based on these triggers, you update the liability. What discount rate is used for this remeasurement?
This is a crucial distinction, especially for exams. A revised discount rate, IBR or implicit rate at the reassessment date, is used only if the change is due to reassessing the lease term or the purchase option. For other changes, index rate, RVG, in substance fixed, you generally stick with the original discount rate used at commencement.
Only revise the rate for term or purchase option changes. Why the difference?
The logic is that changes to the term or purchase option fundamentally alter the enforceable period or the nature of the contract, justifying a new rate reflecting current conditions. Changes due to indices or RVGs are seen as adjustments within the existing contract's parameters, so the original rate still applies.
Okay, that distinction is vital. Now, what if the contract is formally changed? Lease modifications.
A lease modification is a change in scope or consideration not in the original terms. Lessees classify these in two ways.
Two ways. Okay, what are they?
First, it's treated as a separate lease if both. A, the modification increases the scope, the example adds an asset, and B, the consideration for the increase is commensurate with the standalone price for that increase. If so, it's accounted for as a brand new separate lease.
Increase in scope, priced fairly new lease. What if it doesn't meet both conditions?
Then it's not accounted for as a separate lease. The lessee remeasures the existing lease liability by discounting the revised lease payments using a revised discount rate, IBR, or implicit at modification date. The corresponding adjustment generally goes to the ROU asset. However, if the modification involves a decrease in scope, like giving back space, the ROU asset is decreased proportionally, and any gain or loss on that partial termination hits P&L immediately. If it's an increase in scope but not a separate lease or just a change in consideration, the adjustment for the liability remeasurement just goes to the ROU asset. No immediate P&L impact typically.
So crucial to know if it's a separate lease or not. If not, whether scope decreased, P&L impact, or just increased change consideration, ROU asset adjustment. Lots of paths there. After all this calculation, how does it look in the financial statements? Presentation. For lessees. On the balance sheet, ROU assets are presented separately or within the same line as owned assets, with disclosure. Lease liabilities are presented separately or disclosed if included elsewhere. They must be visible. In the statement of profit and loss, as we said, depreciation on RU assets and interest expense on lease liabilities must be presented separately. Variable payments not in the liability and short-term low-value lease expenses are usually in operating activities. In the statement of cash flows, cash payments for the principal portion of the liability are financing activities. Interest portion is also usually financing, but payments for short-term, low-value, and excluded variable leases are operating activities. Initial recognition is a non-cash item disclosed separately.
Clear splits on the P&L and cash flow statement depending on the nature of the payment. Makes sense for transparency. What about disclosures in the notes? Disclosures are extensive, aiming to help users assess the effect of leases. They include quantitative info like ROU asset additions, carrying amounts by class, a maturity analysis of lease liabilities, separate from other financial liabilities, depreciation, interest expense, expenses for exempt leases, total cash outflow, and qualitative disclosures cover the nature of leasing activities, Future cash outflow exposures not in the liability, like variable payments, uncertain options, guarantees, restrictions or covenants, sale and leaseback details. The standard encourages even more info on flexibility, restrictions, sensitivity, etc. to give a full picture.
Comprehensive indeed.
Okay.
That covers the lessee side in detail. Let's switch perspective now to the lessor. How do they classify leases? I understand their world didn't change quite as dramatically.
That's right. Lessor accounting retains the two-model approach from Ind AS 17, but classification is still fundamental. A lease is a finance lease if it transfers substantially all the risks and rewards incidental to ownership to the lessee. If it doesn't, it's an operating lease. Classification depends on substance over form.
Risks and rewards transfer. How do you assess that? Are there specific indicators?
Yes, paragraphs 63 and 64 give indicators that normally lead to finance lease classification. 1. Ownership transfers by the end. 2. Lessee has a bargain purchase option, reasonably certain to exercise. 3. Lease term is for the major part of the economic life, often interpreted as 75% plus. 4. PV of lease payments is at least substantially all of the fair value, often interpreted as 90% plus. 5. Asset is specialized, usable only by the lessee without major changes. Other indicators involve lessee bearing cancellation losses, benefiting from residual value changes, or getting a super cheap renewal option.
Those are pretty clear tests. What about leases of land and buildings together? Land doesn't really have a finite life.
Right. For land and buildings, a lessor must separately assess each element's classification because land normally has an indefinite life. You allocate lease payments based on relative fair values. If you can't allocate reliably, the whole thing is usually a finance lease unless both are clearly operating. But if the land element is immaterial, you can treat it as one unit, using the building's life for classification.
Okay, separate assessment for land building, unless land is immaterial. Are there specific terms for lessors we need to know?
Yes, mainly for finance leases. Gross investment in the lease. Lease payments receivable plus any unguaranteed residual value. Total expected inflow. Net investment in the lease. Gross investment discounted at the implicit interest rate. The receivable amount recognized. Unguaranteed residual value. Portion of residual value the lessor is exposed to, not guaranteed by the lessee or an unrelated third party.
Gross, net unguaranteed residual. Got it. So how does a lessor account for a finance lease once classified?
At commencement, the lessor recognizes a receivable equal to the net investment in the lease. They derecognize the underlying asset and recognize any selling profit loss. For non-manufactured dealer lessors, initial direct costs are included in the net investment measurement, reducing income over time.
And for manufacturer or dealer lessors, you mentioned they're different.
Yes, they recognize selling profit or loss at commencement, like an outright sale under Ind AS 115. Their initial direct costs are expensed immediately because they relate to earning that selling profit. They are excluded from the net investment.
Selling profit based on fair value, less carrying amount, net of unguaranteed residual. Lots of components there for them. How about subsequent measurement for finance leases?
Lessors recognize finance income over the lease term, based on a pattern reflecting a constant periodic rate of return on the net investment, using the implicit rate. They also apply derecognition and impairment rules from Ind AS 109 to the receivable. And they need to review estimated unguaranteed residual values regularly.
Okay, recognize receivable, earn finance income. What about modifications to finance leases?
If it increases scope and price is fair, it's a separate lease. If not, and if it would now be an operating lease, you account for it as a new operating lease. Otherwise, Ind AS 109 modification rules apply.
Right. Now, what about the simpler case? Operating leases for the lessor.
Much simpler. The lessor recognizes lease payments as income, usually on a straight-line basis, or another systematic basis if better. They keep the asset on their books and recognize costs like depreciation per Ind AS 1638 as an expense. Initial direct costs for operating leases are added to the carrying amount of the underlying asset and expensed over the lease term, matching the income. Manufacturer dealer lessors do not recognize selling profit on operating leases.
Add IDCs to the asset for operating leases and modifications.
Operating lease modifications are accounted for as a new lease from the modification date.
Okay. And presentation disclosure for lessors.
Balance sheet. Finance leases show as a receivable. Operating lease assets remain presented according to their nature. EVU GPG. Disclosures are extensive. Selling profit, if applicable, finance income, variable lease income, maturity analysis of receivables for finance leases, lease income for operating leases, details of leased assets for operating leases, risk management strategies, all aimed at showing the amount, timing, and uncertainty of cash flows.
Got it. Lessors keep the finance operating split, with different accounting and disclosure for each. Now let's tackle some other complex areas, starting with subleases.
Ah, yes, subleases, where a lessee becomes a lessor.
Exactly. What happens when a lessee turns around and leases an asset they've already leased to someone else, the intermediate lessor?
Right, the intermediate lessor wears two hats. They continue accounting for the head lease, their original lease, as a lessee, with the ROU asset and liability. Then, for the sublease, where they are the lessor, they apply lesser accounting rules. The key is classifying that sublease.
How is the sublease classified?
If the head lease was a short-term lease, the intermediate lessor exempted, the sublease is automatically an operating lease. Simple. Otherwise, the sublease classification is determined by reference to the right-of-use asset arising from the head lease, not the original underlying physical asset.
By reference to the ROU asset. Can you explain that?
Yeah, this is crucial. Say the head lease is for 5 years, creating a 5-year ROU asset. If the intermediate lessor then subleases for 4 years, they compare that 4-year sublease term to the 5-year ROU asset life, not the building's, say, 40-year physical life. This often means the sublease is classified as a finance lease because they're transferring most of their right to use the asset.
Ah, okay. Compare sublease term to ROU asset term. So what's the accounting if the sublease is finance versus operating?
If the sublease is a finance lease, the intermediate lessor derecognizes the ROU asset from the head lease that's transferred, recognizes a net investment in the sublease receivable, keeps the original head lease liability, and recognizes any difference in P&L. They then earn finance income on the sublease and pay interest expense on the head lease, if the sublease is an operating lease. The intermediate lessor keeps both the ROU asset and lease liability from the head lease. They recognize depreciation and interest on the head lease and separately recognize lease income from the sublease.
Dual accounting if it's operating. And a quick note on exemptions.
Yes, an intermediate lessor cannot classify the head lease as a low-value asset lease if they intend to sublease it. That exemption's blocked. The sublessee, meanwhile, just accounts for their lease normally under the lessee model.
Okay, subleases are complex, driven by classification against the ROU asset. Now, another tricky area. Sale and leaseback transactions. Selling an asset and leasing it right back. How does IND AS 116 handle these?
The absolute first step is determining if the transfer from the seller lessee to the buyer lessor is actually a sale under IND AS 115 criteria. Did control truly transfer? Substance over form again.
Okay, step one. Is it a sale? What if it is a sale?
If the transfer is a sale, the seller lessee measures the ROU asset from the leaseback at a proportion of the asset's previous carrying amount, the proportion relating to the right of use retained. They only recognize gain or loss relating to the rights transferred to the buyer lessor. So if you retain 80% use, you only recognize gain loss on the 20% transferred. The buyer lessor accounts for the purchase and then the lease using lesser rules.
Proportional ROU asset and gain loss recognition, that's a big change, prevents booking huge gains if you retain most of the use. What if the transfer is not a sale under IND AS 115?
If it's not a sale, it's treated as a financing arrangement. The seller lessee keeps the asset on their books, no derecognition, and treats the proceeds received as a financial liability under IND AS 109. The buyer lessor does not recognize the asset but recognizes a financial asset, a receivable, under IND AS 109 for the funds provided.
So, financing treatment if control doesn't pass. What if the sale price or lease payments are off-market, not fair value?
In AS 116 requires adjustments for off-market terms to reflect economic reality. Any difference between sale consideration and fair value, or between PV of contractual payments and PV of market payments, is treated as either. Additional financing from the buyer lessor, if sale price FV or payments market, or prepayment of lease payments by the seller lessee, if sale price FV or payments market. These adjustments ensure the ROU asset and liability are measured at market terms, preventing artificial gains or financing being hidden.
Adjustments bring it back to market reality. Okay, that covers sale and leasebacks. Finally, let's touch on transition. How did companies adopt INEAS 116 initially?
It was a big task.
Yeah.
Effective from April 1st, 2019. Lessees had two main approaches.
Two approaches.
1. Full retrospective approach. Apply IND AS 116 as if it always existed, restating prior periods per IND AS 8. Most comparable, but very burdensome. 2. Modified retrospective approach. More common. Recognize the cumulative effect at the date of initial application, for example, April 1st, 2019, without restating prior periods.
Modified retrospective sounds easier. How did it work for existing leases?
For leases previously classified as operating leases under IND AS 17, recognize a lease liability at transition, PV of remaining payments discounted at the IVR at transition date. For the ROU asset, two choices, lease by lease. One, measure as if in AS 116 applied since commencement but using the IVR transition date. Or two, measure it equal to the lease liability, adjusted for any prepaid accrued rent. This was often simpler. For leases previously classified as finance leases under IND AS 17, just carry forward the existing asset and liability balances from IND AS 17 at the transition date. Essentially no change for those.
And there are practical expedients for the modified approach.
Yes, several helpful ones for those old operating leases transitioning. Using a single discount rate for similar leases, relying on onerous lease assessments under IND AS 37, excluding short-term leases ending within 12 months of transition, excluding IDCs from the initial ROU asset measurement, and using hindsight for lease term assessments.
Okay, those would have certainly eased the burden. What about lessors in transition?
Generally, no adjustments for lessors, except for intermediate lessors who had to reassess sublease classifications based on the ROU asset of the head lease. And for sale and leasebacks done before transition, no reassessment of the sale part was needed. They just continued the IND AS 17, accounting for deferred gains losses.
Oh, that was an incredibly detailed and thorough deep dive into IND AS 116. We've covered everything from its core objective of transparency to the granular process of identifying a lease, the nuances of component separation, lessee accounting, lessor accounting, right through to transition. It's abundantly clear that this standard brings a new level of clarity and, yes, complexity to financial reporting.
Indeed. The shift to the right-of-use model for lessees fundamentally alters how their financial position is presented, making it significantly harder for off-balance sheet financing to obscure a company's true obligations. For our listeners, especially those preparing for application-based questions, grasping every detail from substantive substitution rights to the distinctions in variable payments, the specific discount rates for remeasurement is absolutely key. This standard really demands precision.
So what does this all mean for the big picture? In AS 116 demands significant judgment and analysis, looking at economic substance over legal form. It's not just about numbers, it's about understanding the underlying economic reality of lease contracts and reflecting that transparently. And for a final provocative thought to chew on, given the detailed rules around lease classification, modifications, and the impact on ratios like debt to equity, how might a company strategically structure its lease agreements today within an AS 116 to influence its financial ratios and present a particular picture to investors? Is there still room for strategic maneuvering?
That's a great question. While IND AS 116 closed major off-balance sheet loopholes, smart structuring around, say, variable payments that remain off liability, or carefully balancing non-cancelable periods versus extension options could still subtly influence reported metrics. It likely shifts the game towards managing the volatility and presentation within the standards framework rather than outright avoidance. Financial statement users definitely need to remain vigilant and analytical. Thank you for joining us on this deep dive.
That's all the time we have for this deep dive into IND AS 116. Keep learning, keep questioning, and keep digging deeper into the information that matters. Until next time.